Okay, so the breaking news there, Reserve Bank Governor, Lesetja Kganyago, keeping interest rates on hold, 3.5%, that decision from the Monetary Policy Committee. Some interesting insights coming through in terms of the actual economy as well and what they see as happening. Let's get some reaction to this breaking news. It was widely expected. Ndumiso Hadebe is an economist and director at Pax Africana Holdings. Ndumiso, good afternoon to you. I mean, this was expected. No surprises here.
Certainly, no surprises, Stephen. And I think the context of the CPI data that came out this week from Stats SA, it speaks to the anticipation as to why the Reserve Bank would hold rates, specifically in the season and this period that the South African economy finds itself in. I think in the medium term, the governor did certainly highlight that they do anticipate that headline inflation will remain contained at 4.5% for both 2022 and 2023 going forward. And I think it speaks to the relative moderation of containing inflation going forward. He also highlighted some key elements around the role of aggregate demand and how that will continue to contain inflation comfortably within their budget, within their range, but their 3 to 6% inflation range as the Reserve Bank.
I mean, obviously, what's interesting is that this was a unanimous decision. Everyone looked at the evidence and everyone agreed. There was no lone call for another interest rate cut.
Indeed, indeed. I think even when you look at the core inflation number at 3.3%, which is the long-term trajectory of inflation going forward, when you exclude volatile cost-push items such as the cost of food, non-alcoholic beverages, the cost of energy, you see that core inflation, looking at the longer-term trajectory, remains well contained. Some of the interesting events that will certainly affect the trajectory of inflation going forward is certainly, number one, of course, what you've highlighted around the impact of the containing of inflation due to demand side lackluster performance, but also the 15% tariff that will take effect by Eskom is also likely to have a pass-through effect in inflation in subsequent quarters. And of course, certainly the currency-associated risks that are linked to our fiscal position as a country, but also global geopolitical events are then likely to also have some kind of impact, as that will also attribute to the performance of the price of oil, which then may also have some pass-through effect when it comes to the headline number. Hence, for the quarterly projection model for the South African Reserve Bank then anticipates that it would moderate at 4.5% for the next 2 years.
So, Ndumiso, so long as, no one blocks the Suez Dam by planting their ship there by mistake, oil prices won't jump too much. And instead, someone went and planted a ship, and that's had a knock-on effect on oil prices. They were going up already, of course, quite dramatically before that. Again, the big variable in everything at the moment is the pace of the COVID-19 vaccine rollout here and in other countries. That's still the big variable.
It certainly is. Especially when you look at the uneven pace of distribution of the vaccine rollout in different parts of the world, as the economic recovery, not only domestically, but globally, is closely linked to the accelerated pace of the vaccination rollout across the globe. Now, due to the uneven pace of the distribution of the vaccine rollout globally, it therefore means that we are likely to also record an uneven pace of recovery globally. And I think in the South African case is also affected by that. Subsequent to that, that certainly does have some demand side effect when it comes to global inflation. We would know that in certain parts of the developed world, the goal certainly in the U.S. Federal Reserve is to ensure that inflation does certainly pick up, and there would be a drive there to ensure that aggregate demand is certainly stimulated to ensure that there's somewhat of an acceleration in that part of the world. In the South African case, we certainly do have challenges on the demand side, which also have some kind of interplay on the supply side of things in terms of what we're doing for the productiveness of the South African economy. But the effectiveness and the efficacy of the vaccine rollout certainly will play an important part in terms of it being a directing variable in terms of the inflation outlook in the South African economy, and of course the yields that we see in the bond markets.
I mean, there's so many things to it at the moment. It does, and the Reserve Bank Governor said this, not the first time he said this, it's going to take some time before we get back to pre-pandemic output levels. In other words, before the economy gets back to the size that it was before COVID-19, before we get those jobs back.
It certainly will, Stephen. I think even when you look at the performance, I think quite recently we've seen some results coming out from the banking sector and the performance of financial services institutions, and they've also been adversely affected by somewhat of the lackluster performance of the demand side factors in the South African economy. It's also affected additionally by the performance or the rating that the South African economy has from a credit rating perspective, which permeates to affecting the standing of financial institutions as well. That resultantly has an implication in terms of the money supply that can be appropriated in the South African economy, and of course that has a real impact when it comes to households and of course businesses alike, which then are quite crucial in driving the recovery story for the South African economy. So certainly there's a permeation effect that is interlinked, and there's an interplay that closely ties the South African recovery story going forward.
It used to be, and I mean, you know, the good old days, remember them, let's call it 3 years ago, you would say that an interest rate decision took 18 months to have a big impact, right? We've now been at historically low interest rates for a year. In other words, we haven't actually seen the full impact yet.
Well, certainly. I think the South African case, there are a factors that are at play. On the one side is the short-term stimulus that we would certainly want to realize from the cut in interest rates and, of course, stimulating aggregate demand. But on the other side, the South African economy and its makeup is there are large blockages that are largely informed by the productive capacity of the South African economy. And those are really linked to the structural issues that have been cited since time immemorial around what needs to be done to really unlock those issues, because when you're able to ensure that the supply side is buoyant and robust enough to ensure that it has demand side absorbers, that is when you see the real impact of the potential of monetary policy in action, not only from the perspective of ensuring that demand side activities are driven, but then you also see some of the real impact that it has in forms of development, economic growth, and some of the macroeconomic fundamentals such as unemployment, and also looking what it does on the side of inequalities.
Well, I mean, it's also interesting because there'll be many, many people who've bought the first home, their first home, and in fact probably the first home in the history of their family. They'll have used this time to pay back debt if they still have an income.
If they still have an income, certainly. So for consumers who have a significant burden, or who have had some kind of burden when it comes to loans or credit lines, they certainly, one would anticipate that they would have taken advantage of this specific period of this low interest rate environment. And of course, we've seen the property markets as well, especially for real estate that is below 1 million rand. We've seen some level of uptick as a result of the Repo in this instance. However, for savers, unfortunately, it has not been such a great story, because it does have the simultaneous effect of having lower capital returns on the side of savers. So it's been quite a mixed picture, but I think on the side of folks who have been burdened by debt or who would have wanted to acquire some level of property, this would have been a season to certainly do so. But again, if your interest rate or your mortgage, as it were, is on a variable basis, then certainly as interest rates would be anticipated to then pick up in the subsequent years, then that would have an impact in terms of the payable amounts on whatever mortgage that you may have taken up.
There's so many different things to consider, and I mean, still we keep always coming back to vaccination rates, what's going to happen with the pandemic. I mean, you know, we could have another family meeting and everything changes, although that seems unlikely at the moment. Certainly wouldn't be a dramatic change. We could have a new variant which emerges, which changes everything. We could suddenly see industrial capacity in the Serum Institute of India and other places suddenly pick up a huge amount of capacity and start rolling out vaccines faster than anyone thought possible. It's kind of hard to know where our economy is going to be in 2 years' time. It seems hard to know where it's going to be in 6 months' time.
It is quite hard, Stephen, and I think as a response to some of the challenges that South African economy continues to face, in this point and in the season, I think it's very important for South Africa to stick to the fundamentals, but also to really chart a new path around how then do we begin to leverage the adverse effects that the COVID-19 pandemic has had on our economy to accelerate the pace of development and of the reforms that are required. And I think this then creates that burning joining platform to ensure that the policy responses to the COVID-19 pandemic certainly does transform the South African economy to ensure that it's sustainable, to ensure that more and more people have access and opportunities to be able to work, to ensure that industries are buoyant and robust and are competitive with global markets, and certainly to ensure that the education outcomes, both from an education, training, and skills perspective, does meet the labor market requirements, especially for an economy that is changing. One of the things prior to the COVID-19 pandemic that governments around the world have been really has been at the center of their discourse has been the impact of the fourth industrial revolution in changing and evolving industries and economies around the globe. And of course, South Africa has not been left outside of that conversation. What it therefore means is that and transforming the South African economy, we then need to look at what does then, as more and more businesses and organizations are driving digital transformation as a result of the pandemic, what does that look like for a public service that undertakes a digital transformation program that is able to deliver services to South Africans in a meaningful manner? What does it also mean for businesses who are undertaking a digital transformation drive to be able to compete domestically and globally in an increasingly competitive market environment, but also supported by not only monetary policy that is accommodative, but also fiscal and industrial policy that ensures that the incentive structure that are put together from an economic policy perspective ensures the sustainability and the growth and prosperity of South Africa's economic fortunes going forward.
Ndumiso, Hadebe, thanks very much indeed. Really do appreciate the time. Pan Africana Holdings, Economist and Director there. All right.